Imagine you have been running a coffee shop called Brew Cafe, and it has been collecting rave reviews and business seems booming. But how do you know if it's actually profitable? The answer lies in understanding its financial performance, and for that, you'll need to know some key terms. Let's break them down simply. Revenue is what every business looks at first. It is the total amount a business earns from selling its goods or services. If Brew sells 500 cups of coffee a day at $5 each, that's $2,500. Daily revenue from coffee alone. Add pastries and sandwiches that make the total revenue $4,000. Why it matters? It's the heartbeat of a business, showing growth and attracting investors and lenders. It's the starting point for any financial analysis. But what are the drawbacks of using this term for analysis? Revenue alone doesn't indicate profitability. A company can have high revenue but still lose money as it doesn't account for costs, expenses, or debts. So revenue isn't profit, it's just the starting point. Now let's talk about gross profit. Gross profit is revenue minus the cost of goods sold. It tells us how efficiently a company produces its products. Out of that $4,000 daily revenue, Brew spent $2,000 on coffee beans, milk, cups, and other ingredients. The remaining $2,000, that's gross profit. Why it matters? At Brew, a latte sells for $5. Coffee beans and milk cost $2. Down the street, a competitor spends $3 on the same. Who's running a tighter ship? That's where gross profit comes in. It shows how efficiently business makes its product. Investors use it to compare companies in the same industry. But what are the drawbacks of using this term for analysis? It ignores rent, salaries, marketing, all the real-world costs. A high number doesn't mean business is rolling in cash. It still has bills to pay and other costs to cover. You made $2,000 in gross profit, but after paying rent, salaries, you're left with $500. That's your net profit, and is what Brew Cafe gets to keep. Net profit is the money left after deducting all expenses, like rent, salaries, taxes, and interest from revenue. It's the real measure of a company's profitability. This is why a business can have high revenue but still struggle if expenses eat up the profits. Why it matters? It's the true indicator of a company's financial health, which is why it helps in decision-making, like if the business has to expand, invest, or cut costs. But what are the drawbacks of using this term for analysis? A company can manipulate net profit through accounting tricks. It is affected by non-operational factors like tax benefits or one-time expenses. Let's get little fancy with EBITDA. Earnings before interest, taxes, depreciation, and amortization. Now, like most businesses, the cafe too has taken loans for growing the cafe. The loan interest, taxes, and equipment depreciation are not considered in EBITDA. If the net profit is $500 but we add back $300 of loan interest and $200 in taxes, Brew's EBITDA is $1,000. Investors love EBITDA because it shows how profitable business is before financial obligations. Why it matters? It helps compare profitability across companies without accounting for different tax laws and capital structures, commonly used by investors to assess operational performance. But what are the drawbacks of using this term for analysis? Critics argue this ignores important costs like depreciation and capital expenditures. It's not regulated by accounting standards, so companies can manipulate it. If Brew's net profit is $500 and we add back $300 in interest, the EBIT would be $800. EBIT is useful for comparing businesses because it strips out financing costs and focuses on pure operational performance. But what are the drawbacks of using this term for analysis? Doesn't account for debt costs. High EBIT might look good, but heavy borrowing could still hurt the company. It can be manipulated through accounting practices. You invest $10,000 into new coffee roaster, and after a year, your cafe earns an extra $12,000 in sales. How can we tell if it was a smart investment? That's where return on investment comes in. It measures how much profit or loss an investment generates relative to its cost. It's calculated using a simple formula, that is profit by investment into 100. Why it matters? A higher ROI I means your investment is paying off well. It helps businesses and investors evaluate the success of an investment. It is easy to calculate and compare different investments. But what are the drawbacks of using this term for analysis? Doesn't account for time. An investment doubling in 10 years isn't the same as doubling in 1 year. Can be misleading if expenses aren't fully considered. And there you have it. From revenue to net profit, understanding these numbers helps understand business better.